If you're watching this, don't ever finance a car without understanding what I'm about to tell you, because one signature can quietly destroy the next 7 years of your life. This is not about bad decisions. This is about a system designed to look affordable while it slowly bleeds you. In 2022, in a small apartment outside Dallas, a 29-year-old warehouse supervisor named Jason stared at his old Honda that had just died in the parking lot. He wasn't reckless. He wasn't stupid. He worked overtime. He paid his bills. His credit score was 684. Not perfect, but good enough, he thought. He needed a car to keep his job. No car meant no income. No income meant eviction. The pressure wasn't luxury. It was survival. That Saturday, he walked into a brightly lit dealership. Sales music playing softly. The smell of new leather. A smiling salesman who said the magic words, "We can get you approved today." Approved. That word hit him like oxygen. The car was $26,000. Too much. But the salesman didn't focus on the price. He focused on one number, $489 per month. Jason hesitated. The salesman leaned in and lowered his voice like he was sharing a secret. "With your credit, this is the best deal you'll find. Rates are going up. You don't want to wait." Fear of loss. Urgency. Authority. Jason didn't see a trap. He saw relief. He signed. What he didn't emotionally process that day was this: 12.9% interest. 72 months. Extended warranty folded in. Gap insurance added. Dealer fees buried inside the loan. His $26,000 car wasn't $26,000 anymore. It was $38,742. But that number never flashed on a giant red screen. It was hidden in paperwork. Month 1 felt fine. The car smelled new. He drove to work confidently. He felt like he was moving forward in life. Month 3, insurance jumped because of his zip code. Gas prices spiked. Groceries increased. The $489 felt heavier. Complete. Month 6, overtime hours were cut. Now something changed psychologically. Jason didn't see the car as transportation anymore. He saw it as a threat. He started using his credit card to float groceries. Just until things stabilize, he told himself. Minimum payments. Quiet interest. Silent compounding. By month 9, he was living paycheck to paycheck. Not because he bought something crazy, because one fixed payment was too rigid in an unstable life. And here's the twist most people never calculate. Cars depreciate faster than you can emotionally handle. After 1 year, his car's market value dropped to around $19,000. He still owed over $31,000. Negative equity. He was trapped. If he sold the car, he'd still owe thousands. If he refinanced, his rate would barely improve. If he missed payments, his credit would collapse. This is the psychological prison of auto loans in America. The system doesn't need you to fail immediately. It needs you to survive just long enough to keep paying interest. Then it happened. Month 14, Jason's company downsized. He wasn't fired for performance. He was cut for budget. He got 2 weeks severance. The first payment he missed wasn't dramatic. It was silent. 30 days late. His credit score dropped 78 points. Complete. He felt it physically. Shame. Panic. That sinking feeling in the stomach at 2 a.m. when you open your banking app and avoid looking at numbers. The lender called. Then again. Then daily. He picked up once. "I just need time." Time is expensive in debt. Late fees added. Interest continued. Credit card balances grew. His utilization ratio spiked. His 684 score slid into the low 600s. Complete. Now here's where the system tightens. With a lower credit score, refinancing became impossible. Interest offers were worse. Insurance premiums increased because of credit-based pricing models. One late payment triggered a chain reaction. This is not a budgeting failure. This is leverage against the vulnerable. By month 16, Jason found a new job. Lower pay, longer commute. He tried to catch up. But catching up on a high-interest amortized loan is like running uphill in sand. Most of your payment in early years goes to interest. He was working harder than ever, but the principal barely moved. Then came the breaking point. He opened a letter marked Notice of Intent to Repossess. Not because he ignored everything, because he was 2 payments behind. He walked outside that night and sat in the driver's seat. The same seat that once felt like progress. Now it felt like humiliation. He imagined the truck coming at 3 a.m. Neighbors watching. Car gone. Transportation gone. Job at risk again. That's when something shifted internally. Fear turned into clarity. He realized the car wasn't the status symbol. It wasn't freedom. It was an obligation that controlled his choices. He made the hardest decision of his adult life. He voluntarily surrendered the vehicle. Most people think surrender means escape. It doesn't. The lender auctioned the car for $17,500. After fees and costs, he still owed nearly $11,000. This is called a deficiency balance. Now he had no car and still had debt. His credit score dropped below 560. For 2 years, he couldn't qualify for decent housing without a cosigner. Security deposits were higher, insurance rates higher. Even some job applications quietly weighed his credit history. This is the part no dealership commercial shows you. Debt doesn't scream when you sign. It whispers later. But here's the transformation most people miss. Jason stopped blaming himself alone. He studied the system. He learned how amortization front-loads interest. He understood how dealerships mark up lender rates. He realized monthly payment thinking is a psychological trick. He got a second part-time weekend shift. Not to survive, to eliminate. Complete. He negotiated the deficiency balance down to $7,000 in a lump sum settlement after months of saving. He started using a secured credit card strategically, under 10% utilization. Paid in full every month. No emotion, only math. 2 years later, his score crossed 700 again. But his mindset was different. When he finally bought another car, he did 3 things differently. He bought used. 3 years old. Already depreciated. He secured financing from a credit union before stepping into any dealership. And he negotiated the total out-the-door price, not the monthly payment. Same man, different awareness. Here's the uncomfortable truth for anyone watching in America. A car loan is not just a payment. It's a fixed financial weight attached to a variable life. Jobs change. Health changes. Markets change. But your lender does not adjust for your instability. The system profits from your urgency, from your need to get to work tomorrow, from your fear of losing opportunity. This isn't about never financing a car. It's about understanding that the battlefield isn't the showroom floor. It's the contract. If you're carrying an auto loan right now, ask yourself, do you know your interest rate? Do you know how much of your next payment goes to principal? Do you know your car's current market value versus what you owe? If you don't, you're not in control yet. Jason thought he was buying transportation. He was buying leverage against his future income. And the scariest part? He wasn't irresponsible. He was normal. And that's exactly why this system works. If this story felt uncomfortably familiar, that's not coincidence. It's design. Now the only question is, will you sign your next contract emotionally or strategically?